a good idea. Of course, I don't have the same problems you do, but I might not change it. So, did you try something? Derivatives? Any that would be fun? Somebody want to come up here and work one?
I just have a question.
You want to come up here and work one? Sure.
I'd rather not, but I have a question about the interest rate swaps.
Mm-hmm. Oh, we didn't do anything on that, too.
No, we didn't. I was just wondering, like, how does the company go about switching their interest rate? Swapping
Go ahead.
It's confusing how they can get it from. I'm confused on where they're borrowing like the other interest rate from. I know it's from another party, right?
Mm-hmm.
So it's like, but I'm confused on how they're allowed to do that. And like what, I don't know. There's just, it doesn't make sense as to what you're even doing.
You're renegotiating your debt, I believe.
Okay.
You're finding another lender, interest rate change over time.
Right.
Right? So you can lock in your cash flows with that too, right? It's just the idea, right? So if you renegotiate the debt going forward, where do they talk about it? Make sure I don't screw it. Tell me how that works. Cash flow hedge, interest rate swaps. Here we go, starting on page 939. And on the page before that, 938. So 938, 939, that's in the new one. It's got an illustration 17, 8, 10 maybe, to keep it at the same place. It's talking about swaps.
992.
Under fair 992 on yours?
992.
Boy, there's that many less pages in this, okay. And they show an illustration where they show swap counterparty, Jones Company, bond investors. They keep that the same?
Yeah, it's
okay.
Just hard to wrap my head around.
And what they do is they're paying a variable rate, right?
Mm-hmm.
And then he receives a fixed rate, okay? Let's see how this works. Okay. Let's just read through it. I'm sorry, it's just not clicking exactly how to explain it. To illustrate the use of a swap and a fair value hedge. It starts there under fair value hedge. Assume that, is the reading the same for you guys?
Yes.
They didn't change it. Okay, good. This is the new edition. Assume that Jones Company issues $1 million of 5-year 8% bonds in January 2nd, 17. Jones records this transaction as follows, of course: debit, cash, credit, bonds, debit. Okay. Then Jones offered a fixed interest rate to appeal to investors, but Jones is concerned that if market rates decline, the fair value of the liability will increase. That's true, right? If interest rates change, the fair value of liabilities change too. If interest rates go up, the fair value of the debt goes present value of future cash flows. Fair value of the debt goes down. If interest rates go up, the fair value of the debt goes down. If interest rates go down, the fair value of the debt goes up. Right, guys? Just like a bond market, right? What happens when interest rates change? Okay? Except it could be on the borrowing side or on the investing side, right? The effect's still the same of the change in rates. The company will then suffer an economic loss. To protect against the risk of loss, Jones hedges the risk of a decline in interest rates by entering into a 5-year interest rate swap contract. He agrees to the following terms. Jones will receive fixed payments of 8% based on the $1 million, okay? Jones will pay variable rates based on the market rate in effect for the life of the swap contract. The variable rate at the inception is 6.8, okay? So Jones is going to pay the 6.8 to the swap counterparty. You're going to receive a rate of 8%, right? Okay, but it's variable. Okay, and then Jones pays the fixed rate of 8% to the investors. Okay, so who's taking the risk of the interest rate change? These variable, you guys, what's going to happen? With a variable rate, what happens to you, of course? Your rate changes. With the fixed rate, what happens to you? It's fixed. Okay, so he's receiving the fixed, he's paying the variable. Who's taking the risk of interest rate changes? Jones is, right? But what is his bond investor taking? No risk whatsoever. Okay, what's in it for the swap counterparty to accept this deal? So you're negotiating this separate deal, right? Okay, I'm gonna pay out the fixed rate. I'm gonna receive the fixed rate, so I'm covered. But I'm going to pay the swap counterparty, one, to set up the swap in the first place, right? I'm gonna pay them a fee. And then what else am I gonna do? I'm gonna pay them a variable rate. Well, I'm doing pretty well when I pay them 6.8, but what happens over time? What is the swap counterparty doing? They're betting that interest rates are going to go up. They want them up, not down, right? Although usually with a swap arrangement like that, there's a bottom limit on the variable, right? They won't go below some fixed limit. And sometimes there's a top one too, right? So then this person that is the swap counterparty, they're assuming risk, so guess what they expect to have? Return, right? So, yes, they're accepting the variability, and they may lose, right? Rates could stay low, but if rates go up, they're going to make money. And the expectation is what? They'll make some money. Not a fortune, but their expectation would be that they're going to make money, right? Because they're accepting the variable risk. Yeah.
So if Jones always has that fixed rate, regardless of if the variable rates change, that fixed rate is always going to be paid to that bond investor.
Yeah, the bond
Okay, that's
investor,
where I
a
was-
bond investor has less risk of rate changes,
Okay, that's
right? They have risk of default, but they have no risk of rate changes, right? Their risk is that you wouldn't be able to pay the interest or the principal, right? Of course, right? But still, they get rid of that variability because nobody wants to buy a bond that has variable interest, right? So, plus, it'd be a really pain to write the bond that way, wouldn't it? Because you're selling the bond from one person to another, and the rate's changing all the time. That is kind of fixed. And then if the rate's fixed, of course, it can be discounted based on what the effective rate is, right? Because that changes based on what? What causes the effective rate to change? Interest rates are composed of true, real, nominal return, whatever you want to call it, right? 2 to 3%, we think, plus expected inflation. Those two together are the risk-free plus risk premium. Does risk premium change for companies over time? Of course it does, right? They can be more or less risky, right? So that makes the bond more or less risky, okay? And can expected inflation change over time? Yes. Does the true or nominal return change? Of course not. That's what it is, the rent of the money. Is that helping a little bit? Okay. So that's sort of the story. So does that explain why somebody can get in the game here?
Yeah.
Right? If I'm willing to take risk, guess what I get? Some return. Okay, yeah. And what I'm doing, of course, is I'm doing a whole bunch of these swap contracts. I'm not doing one. So then I can diversify that risk too, right? Spread across a whole bunch of them at different times for different interest rates, and yeah, got it. Okay. Is there any problem with how to record the thing? Where does the gain or loss on these things go? To the income statement. Is that right? Oh, there's something different here then, huh? On an interest rate swap, where did it go? The gain and loss. On the swap contract and on the bond payable. On the next page, where they show the financial statement presentation. So we're using two votes. They show the financial statement presentation, and they show a balance sheet and an income statement, right? What do? They're adjusting it for the unrealized gains and losses, aren't they? But what hits the income statement? They adjusted both of those. The swap contract and the journal entries they adjusted, and the bond payable they adjusted too, right? Okay. But then what happened on the income statement? Both the unrealized holding gains and or loss, right? They have one of each, right? Are there. But then look what happens in a hedge transaction. Look at the income statement. What happened because it's a hedge? In this particular year, they had a gain on the swap contract and a loss on the bonds. And what happened to them? They're exactly the same size. Why? because it's a perfect hedge. I hedged 100%. Right? I have a swap contract for 100% of my debt. That's all I have to do there. Got it? Perfect hedge. Okay. Working. Do the journal entries all make sense to you? By the way, why would the debt change in value? Why would the liability change in value? Why do you have that 40,000 increase in the bond payable? If you look at the journal entries, first they recorded the debt, right? Then they recorded what? On January 2nd, mine says 2017, yours probably says 16 or something, 15, 14, okay, they used the same example, nothing changed here. So the first thing they did, of course, was they recorded the debt, right? That was right under the fair value hedge, January 2nd, 14, I guess, for you guys, 13, okay, they showed debit, cash, credit bonds payable. Then what happened when they signed the swap contract? January 2nd, next year, I guess. No interest. Why? They didn't pay for it. What if they paid them for it? You'd have what? Swap contract, debit, credit, cash. So you'd have a balance in it, right? Just like you would with an auction if you paid for it, right? So you could have that if you paid it, okay? In this case, they didn't, okay? So, all right. So anyway, then there's a regular interest expense, right? Okay, which is just cash paid, right? That's no big deal, okay? Then the next one is what? It says, at the end of 2017, market interest rates have declined substantially. Therefore, the value of the swap contract increases, right? So interest rates are going down. Okay, recall that in the swap, Jones receives a fixed rate of 8%, right? And pays a variable rate of 6.8, so it's 68,000. So therefore, they receive 12,000 as a settlement payment on the swap contract on the first payment date. So they've got this extra 12 grand that they got, right? Debit, cash, credit interest expense. It's reducing because they paid out all the interest and they got money from the swap contract, right? Making sense? Okay, so my net interest expense is only the 6.8%, 68,000. Pretty good. Okay. Then, in addition, the market appraisal that the value of the interest rate swap has increased 40,000. Jones records this increase in value as debit swap contract, credit unrealized holding gain. Jones reports the swap contract in the balance sheet. Reports the gain on the hedging transaction in the income statement. Because interest rates have declined, the company records a loss and a related increase in the liability, which will be exactly the same amount. Okay? Perfect catch. The journal entries are really funny, don't they? The quotas, but it kind of makes sense.
So you increase your bonds payable to the fair value of it?
Yeah. And your fair value changed, why? Because they changed in interest rates. Right? Okay. Why is the debt worth more? %8 down to 6.8. And you really take the present value of it, of course, but it's got to be the same because that's how you got the swap contract, the value of it, right? They'll change by exactly the same amount. They just simplified it by telling you how much it was. But you could calculate that, of course, right? It's got to be the same, right? Explain the same change in interest rates. Okay, good. That's a good one to go. You know, okay. I guess PowerPoint really didn't get into that, did it? I didn't put it in. Should have.
There's a problem.
It does the same thing.
I mean, it's kind of confused. It's on, it's problem 1716.
Did you say it's a problem?
See if it's the same one in both cases. 1716. Cash flow hedge. Is that Lou Jewelry Company?
The one
All I
above it.
see is mercantile.
The one above it, 16.
Mercantile, okay. So this one says 15, but that's fine. Okay, so 16. Okay. So we're on problem 1716 in your book. Fair value hedge interest rate swap. On December 31st, they had a $10 million 8% fixed rate note outstanding payable in 2 years. It decides to enter into a 2-year swap with Chicago First Bank to convert the fixed rate debt to variable rate debt. The terms of the swap indicate that Mercantile will receive interest at a fixed rate of 8% and will pay a variable rate equal to the 6-month LIBOR rate, right? What does LIBOR stand for? London
Something.
International, is it London International Bank? Something, anyway, right? Yeah, anyway. So this is an interesting one too, that we're talking about it on NPR. What's the problem with the Brexit perhaps on this? It might affect this rate. What's based on this rate? Everything, right? Whole bunch of agreements specify LIBOR, right? We don't even know what it is, but it specifies it, right? It's London. So there's some speculation that, right, that might get real unstable, you know, so should we switch to something else? Imagine all the contracts that would switch, but anyway, kind of fun. I enjoy nonsense like that for some reason. Anyway, so hopefully nothing happens. They were talking about getting rid of the 30-year treasury bond too, by the way. And there was some panic related to that. Why? It's the risk-free rate. A whole bunch of us think that's the risk-free rate. What would we have left? What do we have, 5, 10? The government treasury bills. They're 5-year, 10-year. Is there 30 is a treasury bond, but that's the one they were going to get rid of. Is there one 15 to 20? There's a 20, isn't there?
I'm pretty sure there is.
5, 10, 15, 20. So we go to a 20 instead of a 30, but the 20 has a lot higher interest rate right now, sometimes lower, depending on what expected inflation is, right? If expected inflation is real high, what happens? Right now it's real high, people think it's going to go down. So what would you expect to see? On the short term, the interest rates would be lower, yeah, okay, the interest rates go the other direction, right? Okay, so, and now the short term, the interest rate's higher than on long term. Usually if you tighten your money longer term, you get a better interest rate, right? Okay, so yeah, it's kind of, it's inverse from what we thought was normal, but it's been this way a long time. So yeah, but anyway, so that's an interesting one too. Okay, anyway, has nothing to do with this, I guess. We decided to enter into a 2-year swap. Converted, okay, so they got a fixed rate of 8%, will pay a variable rate of the 6-month on the 10 million amount. The LIBOR rate on December 31st is 7%, so there's 1% difference. It'll be reset every 6 months, which is typical on variable rate, and will be used to determine the variable rate to be paid for the following 6-month period. Mercantile Corp designates the swap as a fair value hedge. So you've got to document that you're doing a hedge, right? Otherwise, it's not going to be treated as a hedge. And what would that mean? It's now a speculative position, right? Okay, so you'd account for it as though it were a speculative deal, right? Gains and losses on the investment. Okay, just like a trading security or something. Assume that the hedging relationship meets all the conditions necessary for hedge account. Okay, the 6-month LIBOR rate and swap our debt fair values are as follows. Now the thing to keep in mind about this is it's not running through other comprehensive income, but do you still have basically the same effect on your income statement? Yes, because your gain equals your loss, right? Okay, so it still gives you the hedge. So here's the rate. It's 7% and it goes to 7.5. Is that the first interest payment? When it's 7.5? Let's see, we set the thing up at December 31st, and then on June 30th, 6 months later, the first interest payment is 7.5, right? The swap value became negative 200, right? Okay, the debt value changes by exactly the same 200, huh? Okay, so debt goes down. Yeah, okay. And then on December 31st, it goes the other direction because the interest rate went up, so you had a loss, right, on your swap. When the interest rate went down by 1.5 the next time to 6%, the next 6 months, you're going to have a gain, right, due to that. Okay, makes sense? Swap value changing, but then the debt fair value changes too. And again, for the fair value of the debt, what are we doing? Discounted present value of all the future cash flows. Interest payments, right? Valuing the bond is all it is. Okay, right? And the marketplace should be valuing the bond exactly the same way, you would think. Okay, all right. Anyway, assuming your risk level is not changing. Present the entry to record the swap. Okay, did they pay anything for the swap? No, so should there be an entry? I guess not. Okay, I think not. Semi-annual interest payments, how much is the interest? We are paying what, 8%? Yeah. Okay, they're gonna receive 8% interest and pay a variable rate, okay? So how much interest are we gonna pay on the first, 7.5 times the 10 million, is that right? Okay, for half a year. And how much interest are we gonna receive? 8% of it, right? This is a note payable outstanding. No, we're gonna receive the 7.5 and we're gonna pay the 8, is that what it is? Yeah, and then we have the 200. And then the entry required settlement, that's when they give us the difference. And then the change in fair value, that's gonna just adjust the debt, right, and the swap both, the debt and the swap at June 30th. And let's see, shouldn't we also do one at December 31st? They don't ask for the entries, but you would have to do the entries to get part B, right? You do it at December 31st, 17, that's the beginning, is where it was. And then the balance sheet at June 30th is after your June 30th entries. But in order to get the balance sheet and income statement at December 31st, what are you going to have to do? Make those entries again, right? You're going to make the entries twice, I think. Okay, is that what you did? You guys have the answers? So show it all to us.
Yeah,
I just didn't know what was going on and who was paying who what and at what rate.
Okay, this time we have a note payable, right? Where we are paying are we paying variable or are we paying fixed?
8 fixed.
We are paying 8 fixed and we wanted to convert it to variable?
Yes.
Okay, and so, and then we have the swap to protect us on that, right? Okay, so we're gonna pay the variable, right? So they're gonna make up the difference, right? Okay, so what happens? All right, so let's see if we can get, so we just got straight to move it. And this one is a bear, kind of. Stuff is kind of brain teasers. 17A. And let's go.
It's opening up on this other screen.
Okay, it's opening there.
It's opening on the projector screen over here. It's hidden behind the whiteboard.
Oh, okay. Gotcha. That one. That should be there now.
Yeah.
If I put it back up.
Very much.
There. All right. And then we want to go to what problem?
16.
There. 17. 16.
Be able to drive that little guy at the bottom over.
They'd be able to, oh, this? No, that's the size.
The bar that's going down across the screen. Oh, it just disappeared.
Oh, it just disappeared.
See
There
the
it
little
is.
slider moving at the bottom?
Oh, there it is.
Yeah.
Got it. There it goes. Where are we at?
Right past.
Almost
79.
Close.
What number are we?
16.
Oh,
This is kind of ridiculous. It's gotta be, that's better though, isn't it? this isn't really set up for it, obviously. Okay, there we go. All right, so we were right on that, okay? It's the 8%, oh, it's half a year, come on. 8% times 10 million for half a year, right, is the cash we pay out. We are paying 8%, but we want our net effective rate to be variable, right? That's what they were trying to do. Okay, so then, why is it not doing that for us? Okay, all right. And then how much are we gonna receive? The rate on the variable rate is 7.5, right? We paid 8, so how much do they owe us on the swap contract? The difference between 7.5 and 8. Make sense? So then they're giving us the 0.5%. Does that work?
So they're covering us.
They're covering us. So what we ended up paying is 350, which would be 7.5. Is that right? What's 8? What's 10 million times 7.5?
They use the 7% instead of 7.5.
Oh.
Right below.
Well, they did.
Oh,
The agreement must be that you pay interest based on LIBOR at the beginning of the period, not the end of the period, which kind of would make sense, I guess, right? On your swap, your interest rate is over the time, right? Interest is every day, not the last day of the period. So they're using the beginning LIBOR for the period to determine the amount that's effective interest rate in the swap. So that doesn't make sense. Okay, so you've got 7% compared to 8%. So it's 1% on 10 million, but it's only half a year, right? 1% on 10 million would have been 100,000, so the effect is 50,000 difference. So thank you. Yeah, then that makes sense, right? Because you wouldn't know what the ending rate is until after you paid the interest, and then until after they paid you, right? Oh, okay. So anyway, so we've got 50,000. So they're going to send us a check, okay? So the net effect is that we paid 7% instead of 8. Makes sense, guys? Okay, and then I wish this would just let me move a little bit. I don't know why it won't.
You gotta
Change this. Fill that off. No. Now will it do it? No.
You had changed the view.
Oh, to this?
Yeah.
That should do it. There we go. All right, much better. All right, and so then, what happens on June 30th? This is the change in the value of our, do you have any notes payable?
Fair value of the notes payable.
Fair value of the note payable changed from what to what? So it was 10 million. Now it's 9.8. Right? So you actually adjusted your debt to the discounted present value of those future cash flows, right? That's where, okay? And so reducing the note payable and the subsidiary income statement, but then what happens on the swap, of course? It changes by exactly the same amount, right? Why would it change? Interest rates changed. It's the same reason that the value of the debt changed, okay? Right? So, and what's the derivative here? The swap contract is based on what? On the debt value and the interest rate, right? Okay, so what's the underlying asset or liability that determines the value of the swap? The note payable. Got it? That's it. That's why the swap contract has any value whatsoever. Okay? And when does it change in value? When interest rates change. When does the bond change, or the long-term debt, the note payable change in value? When interest rates change. And they change by exactly the same amount. The idea of a hedge. Is that any better? It is tough to get your head around what's going on. Okay. Okay, so those offset, so when you do your financial statements, what happens? At 2014, of course, you just have the note payable, What's gonna happen the next year? You wrote your note payable down, but what do you have? The swap contract to replace it, right? Okay, on the income statement, you paid 400, but you got 50 back, so you have 350, right? And the unrealized holding gain and loss, right? Unrealized holding gain this time on the notes payable, right? Because you now, in real dollars, owe less, right? But your swap went down in value by exactly the same amount. Okay? Everybody got it? Okay, and a swap contract is a liability, right? Okay. And by the way, was this a good deal for you this year? Oh, you got 50 grand. Yeah. Okay. It's all right. Yeah. Was it what you expected to get? No. Right? Well, I guess the first year it is. Second year it's not. Right? Okay. On the second, so then at December 2015, what has to happen between? And they should have just gone ahead and done the journal entries. Let's think about what they would have been. December 31st. What would you have to do at December 31st interest? What would they look like? What would you do to your note payable? It's now 9.8, right? And what do you want it to be at the end?
Well, on December 31st,
It's 10,060, isn't it? So what would your entry be?
debit the swap contract.
You're going to have to adjust both of them. Let's go ahead and write the entries. What would it look like? Okay, it's at 9.8 now for your debt, right? What do you want your debt to be? What do you want it to be now? What is it? 1006. So how much should it go up? 260. You do that, right? What are you going to debit for 260? What did we have before? Unrealized holding gain or loss, right? That time it was a gain. What's this one? Unrealized holding gain / loss. And that does go in the income statement, right? Stays on the income statement. So instead of having a gain, we have a loss this time. Got it? Okay. By the way, would that one be closed? Goes to the income statement. Would it be closed? Yeah. Right? It's not other comprehensive income. It's running through to retained earnings, isn't it? But both of them are. It has zero effect. Okay, so then what's going to happen to your swap? The swap now has what in it? Credit balance, right? Swap has a credit balance. It's a swap liability, 200,000. What do you want it to be now? Now it has what? A debit balance of conveniently 60. How do you take that liability, the swap, right? They call it a swap liability today. No, just swap contract with a credit balance, okay? We're going to debit swap contract, so we can use the same account, can't we? But instead of showing it with liabilities, where are we going to show it, of course? It's an asset now. How much did it change by? It was 200 credit. We now want it to be a 60 debit, right, guys? So isn't that 260? Yeah, it's very convenient, isn't it? Exactly the same number. And what are you going to credit? Instead of having a loss, a holding gain or loss, that's a loss with a debit to the income statement, what do? We have a gain. Yeah. So this is going to be another unrealized holding gain or loss, right? Only this time it's a gain, of course, for 260. And when we put it on our income statement, what are we going to have? A loss of 60 on the note and a gain, a loss of 260 on the note and a gain of 260 on the swap contract, right? Then on our balance sheet, we will show what? We started with notes payable of what? We think back at it, it started as 10 million, right? Is that what it was?
Yeah.
And what did we do? We debited it for 200,000 the first year, and that gave us 9,000,008. But we had a swap contract for 200,000, right? So we're still 10 million, okay? And then this year, we did a 260 debit here, which left us with 60 in here. We did a 260 credit in here, which leaves us with 10,060. True? And the difference between these two is still 10 million. It's going to always be 10 million. Got it? It's much ado about nothing, isn't it? Right? Okay, but what have they accomplished? What are they really paying? The variable rate. That's what they wanted to do. Right? Okay. And because it's a perfect hedge, what impact does it have on income? Nothing. Right? Pulled it off. So you can see the business purpose of it too, right? Okay. And does the accounting make sense? The journal used to drive you crazy, but does it make sense? Yeah. Okay, so in order to get down here, at 15, they had to make those journal entries, right? Okay. Oh, Jesus. We had, it was in the same year, December 31st. This was at June 15th. So we'd have to add the two of them together with me. Okay. So the interest expense for the first 6 months and then the next 6 months. Yeah. So you'd have to get both of them. How much are they going to give us this time? We're going to do that too. How much are they going to give us? We'd have to record our cash that we paid out. How much cash are we going to pay out? How much interest do we pay? 400,000, right? So would we still have this entry, debit, interest, expense, and credit cash? Yeah. And then how much are they going to give us? What happened to the interest rate? It went from 7 to 7.5. So for this period, it'd be at the 7.5, wouldn't it?
So we're getting 25,000.
So they're going to give us 25. Yeah. So if they gave us 25, then that would be debit cash 25 and credit interest expense 25. So our interest expense is how much on it this time? 375 this time, right? Plus the 350 from last time is 725 total, right? And there's the unrealized holding gain or loss of 60 offsetting, right? That's the, all within the same year. That's the net of this, right? Okay, so I've got in one period 200 holding gain or loss on the notes. In the other period, it was a 200 gain, and then a 260 loss there, and then the same thing here, right? Okay, it was a 260 gain this time and a 200 loss the other time. So the other 6 months. So they offset, of course. Lovely. Okay, what do you do with the 6% for next time? And there they're showing. What do you do with the 6% for next time? Drawn over there. What do you do with that? That's for next time's interest rate, right? So we didn't need it in the problem. Right? What's going to happen to him the next time, by the way, if it goes to 6%? I'm going to pay 8. So 400,000. 6 would have only been 300,000. I have 100,000 saved interest on it, right? Okay, but so that's going to give me 100 cash back from them, which is going to reduce my interest expense. But then what do I have in the swap contract? The debt's changing. We have a loss. Let's see they showed us. No, they didn't show us the new one. We'd have to get the new value at the end of the next period. Yeah, but we would have a what? If interest rates are going down, what do we have on these? We have gains, right? Yeah. The debt's going up, gain on the swap contract, right? Okay. Yeah. Okay. Loss on the debt, gain on the swap contract.
But really, at the end of it, you should just save money on your interest and everything else.
That's it. Well, you save money if what? The variable rate is less than the fixed
Yeah.
rate. What happens to you if the variable rate goes above the fixed rate? You lose money. Yeah, so you could have more interest expense or less interest expense than the 800 a year. That's all that's happening. But what are you doing? You're not hitting your income statement with that variability, right? Other than the change in interest expense, right? You're not hitting it with the swap is covering the debt change. Right? That's where the hedge is. Okay, so, but you get to do what you want, right? And not affect the disclosures. Okay. And it's legitimate, it's derivative, it's, saving that. Okay. All right, good. Who picked that question? God. Should at least warn me in advance. I could work on it for a while. Yeah, anyway. Okay. So what else do you want to look at? Try to do a few of these. Not a big deal after you do a few. Does everybody work to do?
You know what we could do is we could look at a couple of things that I didn't get to last time, that are at the end of the chapter.
Somebody asked me, who asked me after class? Was that you? Is this going to be on the test? It's kind of like, I don't want to know it if it's not on the test, right?
I didn't say I didn't want to know.
Yeah, oh,
It's just we didn't know
The controversy and stuff about, well, let's read that real quick.
Were you going to ask something? Somebody was going to say something. No.
We can come back to it.
Okay. At the end, different pages. At the end of Appendix 17A, these are always useful to take a look at. Controversy and concluding remarks, and they have this at the end of each one of the appendices. I think usually at the end of each chapter. At the end here, book. Mine's on page 940.
995.
9 what?
95.
995. Okay. See, they made the book shorter. I bet they didn't. Yeah. See the total.
You then taking out all the extra in there, right?
So that's it. The extraordinary items disappearing did that. Yeah, it took out 50 pages. Okay. Companies need rules to properly measure and report derivatives in financial statements. Actually, we didn't know what to do with derivatives. Nobody knew what derivatives were. Can you see how people would be confused investing in this stuff? Exactly what am I buying here, right? It's pretty hard, isn't it? The good thing about accounting for it is, in order to account for it, you have to kind of figure out what's happening, right? Always true. Which is why I keep telling you guys this, but it's true. Why do so many accounting/finance types end up running businesses? Because they know what's going on. You have to know. These are strange things, though, to invest in, I think. Right? As a hedge, they're wonderful. As a speculative investment, why can't you just gamble directly? Why do you have to gamble through these things? But if I really want to roll the dice on an option, either put or call is really nice for that, right? As long as you know what you're doing. You know that you're placing bet on a bet, right? The stock is a bet. An option to buy or sell the stock is a bet on a bet. Which is okay, you can do that. There are even bets on those bets. You can buy options, buy and sell options. Not kidding, right? So you could keep going, couldn't you? Conceivably. So when they structure these investments, they try to do that. I think disreputable people try to do that. What they do on the subprime loan thing. Packaged them so they looked like they weren't risky when they were. How'd they manage to do that? They hid what they were. Who's at fault with that? Bond rating agencies? Or investment rating agencies? Standard & Poor's? Absolutely. Attorneys that happened to put the deal together and didn't make sure the disclosure was adequate? Absolutely. CPAs that did the disclosures? Absolutely. Right? Tell people what it is if you want them to invest in it. Again, I told you what Lee Thomas said, right? If the person selling the investment vehicle can't explain to him what the investment is, he doesn't want to buy it. If they don't know what it is, they're just selling something. Oh, this is a great deal. So anytime somebody calls you up and says they have a great stock, just bid it. pick for you, hang up the phone. They don't either. If they really knew which stocks were gonna go up, what would they do? Buy it. They wouldn't tell you about it. They're just selling stuff. So those of you who go to work for brokerage firms, don't ever do that. That's not what you do. You manage money. You don't sell stocks. That's bull, right? You manage money. So, and more firms are going that way, right? How do they charge people? A percent of the buy and a percent of the sell? That's the old way. What do you do instead? A percent of the total investment every year, and you manage the money. And by the way, the investment house makes money no matter what. If you get richer, they make money. If you get poorer, they make money. That's always been the way it is, and that's still going to be that way. Of course, they're working for you, right? And you're paying them to work for you. What happens if the market happens to go down? Oh well, you lost money. What if the market goes way up? Everybody's happy. You made money. You love them, right? But they still get their piece either way, of course, right? Far better way to go. So you just want a percent on it. Anyway, but they say, however, some argue that reporting derivatives at fair value results in unrealized gains and losses that are difficult to insure. No kidding. Others raise concern about the complexity and cost of implementing GAAP in this area. However, we believe that the long-term benefits of reporting derivatives at fair value far outweigh any implementation costs, and there are models for doing this. You can, options, for instance, there are option pricing models. Have you guys done those yet in your finance classes? You will. Before you get out of here, they'll make you do it, okay? So, and there, it's just the discounted present value of the expected future cash flows. Everything's valued that way, so options are certainly that way too, but what you do is you try to predict what's gonna happen to the value of the underlying asset or underlying liability, okay? That's the deal. Anyway, so we're not gonna do that. As the volume and complexity of derivatives and hedging transactions continues to grow, so does the risk that investors and creditors will be exposed to unexpected losses arising from derivative transactions. That's true. Statement readers must have comprehensive information concerning many derivative financial instruments, the effective hedging transactions using derivatives. And you can tell that, like all of us, you guys now too, when you start understanding this stuff, you start thinking everybody can if we just disclose it. Is that really true? Look at these disclosures. Do people know what the hell is going on? No. You get to explain it. Right? For financial statement users. What exactly is happening? How can you have a gain exactly equal to your loss? Every time. You do. It's the way the transaction is structured. So, okay. Let's see. Fair value disclosures.
So you're saying that stuff like they're gonna be on the test?
What is? Anything's possible. Right? Anything's possible. Would you like to have a discussion about that on the test? That'd be easy. Yeah. Okay, why? Because I mentioned it, it's definitely on the test? Okay, in 17B. Let's see. Yeah, let's just do it there. You guys have, you gotta get the PowerPoint, but it doesn't really match it. Disclosure of fair value information. You guys know about, we did the reliability on that, didn't we? There's a little chart there, we did that last time.
Is this gonna be, covered on the test? Is that what she was just asking?
Yeah, and basically no, because I only assigned A.
Oh, yeah, I was just wondering. I was gonna read it.
Yeah. Read it anyway, right? What I was suggesting is you might actually want to read B and C, appendix B and C. I should have assigned them, right? But I didn't, so. So what do you do with disclosures of fair values on impaired assets or liabilities? That one we did not do, I don't think, right? What's an impaired asset or liability? It's on the last page of appendix B. What's an impaired asset or liability? So we got it for financial instruments, but also we're going to do it for impaired assets and liabilities. What are they talking about?
You're talking about disclosure of fair values of fair assets or liabilities?
Yeah. What page are you on?
That's on 1003.
1003? Okay. So
what's this about? You have the McClung Company notes the financial statements?
Yes.
Okay, and so they've got, long-lived assets held and used, right, so fixed assets, goodwill, and then held for sale, right, property held for sale. Okay, and so what did they do? They show quoted prices in active markets, they don't have any. They show significant other observable inputs, so they got two of them that have that. And then goodwill, of course, is unobservable, right? Okay, so they actually spelled out to people which level they have. You like that disclosure? You sit across, right? Okay, I've got established prices, quoted prices, I've got other observable inputs, and I've got nothing, right? Long-lived assets held and used with a carrying amount of 100 million were written down to their fair value of 75 million, resulting in an impairment charge of 25, which is included in earnings for the period. So your journal entry for that would just be credit the assets, right? And debit loss on impairment. Impairment loss, you've done that earlier, right? Okay, when we did fixed assets. Okay, so fine. And then it says goodwill with a carrying amount of 65 million was written down to its implied fair value of 30 million, resulting in an impairment charge of 35, which was included in earnings in the period. What do you do with goodwill? You record it at its cost when you purchase it, right? The excess over the fair market value of the assets that you acquired when you bought a company, less the fair market value of the liabilities you acquired, is the fair market value, right, of the equity that you acquired. Compare that to your purchase price, and to the extent that you paid more, you bought goodwill, right? That's what the debit to goodwill is. Okay, the debit to goodwill, what happens then in future periods? You have actuaries come in and determine what? How much is that goodwill worth? So you predict all the future cash flows that are coming from whatever you bought. This is real interesting for an actuary. Whatever you bought, whatever those preferential cash flows you were going to get, what does that mean? My customer base generates so much extra cash flow, right? My relationship with vendors might, my employees might, right? My goodwill, right, is supposed to generate all these future cash flows, right? So they predict what all the future cash flows is going to be, when they're going to be, how much they're going to be, and then they discount them back to now, of course, right, using an appropriate discount rate at that time. And they do it at the end of each year for you. So this is a big deal to value goodwill. What did we used to do with goodwill? We'd amortize it over a maximum of 30 years. That was it. Straight line. You bought it, you'd amortize it. Why did people not like that? Why didn't they like amortizing goodwill? Well, you're reducing its value on the balance sheet, right? An asset.
Does it really go?
And you're putting an expense on your income statement, reducing your income, and it created, it didn't have a tax impact, right? Because it's not a taxable transaction. But yeah, does it really go down? Or does it really go up? Maybe goodwill's increasing in value and we're writing it down over time. It's ridiculous. Why would you do that? So everybody agreed we didn't need to write it down. But then what happened? Could you write it up? No, because what would you do? Debit goodwill and credit, increase in goodwill due to my brilliance or something? You're not going to do that. Revenue account of some kind or gain account, right? We're not going to do that. So we're not going to have gains on increase in goodwill, even though we think our goodwill is increasing. Well, then everybody says, oh, that's good. So don't amortize. But then people start looking around and say, well, wait a minute. What if it does go down in value? Does goodwill ever go down in value? Sure. Do people pay too much for goodwill? Everybody gets excited about buying other companies. There's a merger frenzy going on, and they're acquiring all these other companies. What do they tend to do if everybody's bidding on the companies? Everybody wants to acquire. Drive the price up. Do you sometimes pay too much? Yes. At the time you pay too much, do you know it's too much? No. So you record the goodwill. What do you find out later? It was too much. The famous AOL Time Warner merger, right? Did all kinds of goodwill that didn't exist. And they had to write it all off. It's gone. Okay? So huge loss. This is the loss we're talking about. What do? Credit goodwill, reducing it. The actuaries determined your goodwill is worth less than you have recorded in the books at the end of last year. That amount you must credit goodwill for and debit loss on impairment of goodwill. Got it? That's what this thing is. It's a nice little review of that, huh? Right? But that's where it comes from. So any of you who are crazy enough to become an actuary, you might get to do cool things like this. Predict the future cash flows, but everybody's going to be predicting future cash flows anyway. How much, when, and how risky are they? Right? Bring it back to now. Okay?
So that number varies. By the way, why do you suppose the accountants don't do that? One, we're not mathematicians, but what's the other real reason? We're auditing the work. Can you audit your own estimate? No. So it's an estimate, and these estimates go in the financial statements. Okay, do people understand what goodwill is that are using financial statements that are not accounts? Sometimes, but usually not, right? We try. I talk about even in principles, don't I? Goodwill, those business majors are sitting in there and I'm telling them what goodwill is, you think it sticks? Oh, good luck, right? And they've had a class where somebody talked about it, right? Okay, so then what? And of course they got other things they're worried about, of course, right? So you'll be trying to explain what goodwill is. People will ask you, is it a real asset? Yeah, kind of, they bought it, they paid for it. Okay, but now, what do we have? We used to have amortization, which made no sense. Now what do we have? Write-downs, which nobody understands, right? Can you go forever never having a write-down on your goodwill? Of course, just keep increasing it in value, right? Or keep it at least the same. You'd never have an impairment. Can you hold assets for a long period of time without impairments? Of course you can, okay? By the way, what do you think of the idea of we will do write-downs, but we won't do write-ups? What is that based on? Conservatism. And why would we be conservative in this area? We don't really have a very good measure of the write-up. But then, do you really have a good measure of the write-down? If you don't believe the value, you don't believe the value. So why wouldn't you write it up? You know what we could do is we could write it up and put the credit where? Debit goodwill, increasing it to show its true market value, if we really believe that's the market value, right? Trust the actuaries, right? So fine, you got an estimate, you know, it's more. What could you credit instead of crediting gain on increase in value of goodwill? Give me it. What is it? It's real simple. Where do we put everything we don't know what to do with? OCI, yes. We can put it in OCI as unrealized gain, couldn't we? Right? Some people argued that the write-down should go in OCI too. What would be the argument there? We tell people what we think it's really worth, but we think it's recoverable, right? Some people would argue that one. I don't buy that one. I think you could write it down, run it through the income statement. I'm conservative enough for that. But I kind of like the idea of writing it up. I've seen that before too. People propose that. Well, let us write it up and put it in OCI. But the heck, nobody knows what OCI is anyway. That's pretty, yeah. Well, you guys are learning, right? Getting it down. So that's kind of fun. And then in accordance with the provisions of impairment or disposal of long-lived asset subsections of FASB codification subtopic, wonderful, right in their note. Long-lived assets held for sale with a carrying amount of $35 million were written down to their fair value of $26 million, less the cost to sell $6 million or $20 million, resulting in a loss of $15 million, which was included in earnings for the period. So we wrote that puppy down too, right? To what value? I guess this is an appraised value. But it's less and we're being conservative. Would you ever write up to an appraised value? No, right? So, right with that. So the conclusion with respect to recent FASB and International Accounting Standards Board standard setting efforts, we now have convergence with respect to fair value measurement, both in terms of the definition and measurement guidelines when fair value is a measurement approach for GAAP and IFRS. In addition, GAAP and IFRS have the same fair value disclosure requirements as illustrated in the appendix. As the former chair of the IASB noted, this marks the completion of a major convergence project and is a fundamentally important element for our joint response to the global crisis. What was the global crisis they're talking about? People using derivatives, right, and fair values to do what? Derivatives are valued at fair value, right? Okay. To do what? Swindle other people, right? So if we get on the same page, maybe it'll help with financial crises in the future. The result is clearer and more consistent guidance on measuring fair value where its use is already required. By the way, I might suggest to you guys that you never invest in things that have derivatives involved in them. Of course not. If they're a good deal, go for it. Just know what you're betting on, right? Of course, right? Like anything else. Okay, anyway. Well, have you guys been reading the IFRS stuff at the end of each chapter all the way through? I suggested to you in 211 that, hey, you know, you really ought to do that, but I'm not going to test you on it. So what's the human tendency? Don't look at it too critically. And then what did Dex say about IFRS in 212? What are we doing? With the convergence project, it's going away anyways. There's not gonna be any difference between IFRS and US GAAP at some point, and the major differences are gradually disappearing. This was the big one, right? Gradually disappearing. We still gotta get rid of LIFO, you know, a few things, but not that many, right? We're getting close anyway. So is there gonna be any such thing as IFRS and US GAAP? Yeah, probably. They'll have little tiny differences. You know what they decided to do with this convergence project? Started 10 years ago, maybe? Long time ago, right now, long time ago. At first, what we did was we were actually doing IFRS as part of our theory class, which is now 425, counting 425. You haven't done that one yet. It's now kind of a systems class the way we're doing it right now. I don't know if I like that or not. What theory is you rehash everything that you had from intermediate accounting and advanced accounting. You talk about it from a theoretical perspective. There's some value in doing that, right? You get better and better and stuff. Here we kind of do the theory as we go, don't we? I talk about theory a lot in 211, and here I do. I think Deck probably does a fair amount at least, you know, why we do things, and Schrader always did. So, you know, we're doing it anyway, so we decided, well, we'll use that class for other things. Anyway, the IFRS part of it was were big differences between us and IFRS, and the CPA firms loved it, the big ones, if you knew both. What do they think now of IFRS? How often do you think they talk to us about having you guys ready to handle a world with US GAAP and IFRS? Not at all. Don't even mention it, because it's all coming together. Let me ask you this though. Are we going to get rid of US GAAP and adopt IFRS? No. I bet it never happens. Because we don't really want to join the international community and acknowledge that we're really part of one economy. I guess. I don't know why. I don't know why we do that kind of stuff. But we're really hesitant, right? What did the rest of the world do because they want their economies to grow? They joined up. They got in, right? And does the US have to get in? No. Because we're big enough, powerful enough that we really don't have to if we don't want to. But what did we end up having to do? And they did the same thing. They wanted to do it too. We wanted to get on the same page, right? And so we gradually have. There are other countries that are doing the same thing. I learned as I got further into this, you know what? Germany and France and Great Britain do not account for things the same way. Do they all use IFRS? Yes. But they don't account for things the same way. They have little differences. And they just kind of ignore them and pretend they're still IFRS. Well, they still have differences. And you know what they're going to do with those differences? They're going to leave them there. Because in their country, that's what they historically did. And what do people tend to do? They want to do what they did before. We don't want to adjust. We don't want to change. We don't want to learn something different. Of course, human nature, right? So that's all cool. So for you guys, IFRS is not as big a deal. But I would still suggest to you, read. You might have something on the CPA exam where they just ask you in general about the convergence project, okay? What's going on? What has happened? Where were we? Where has it gone? Okay, so I read through these things, right? So I encourage you to go back while you're getting ready for the CPA exam and read these things. There's no harm in doing it, right? And we're going to talk about IFRS. In fact, we have a chapter on international standards coming up pretty soon. We're going to do foreign currency translation first, and then we're going to talk about international standards, and we'll talk about what those differences are and where they're at. But this book also, that's in the advanced book, this book also does a pretty good job at the end of each one of these chapters, just talking about what do we do that's similarities, differences, and as I've been looking at them over time, in this book now, this new edition, there are fewer differences than in your edition, and more similarities. That's nice. And I think this advanced book, based on where they were on not knowing about extraordinary items, I don't know, maybe they won't have that updated either. We'll see where they're at. So anyway, I'm done with you guys. Anything else? And I'm going to put all of that on your test and nobody else. Wouldn't that be fun? I'll give her an extra question, you guys. Send it home. Then you'd want extra credit for doing it.
I mean, he has like, outer remote desktop. Yeah. Like, I can like work from home, do some I've just been like checking all the.
I scribble all over my
Yeah, how about that?
I will be.
I went out there. Yeah, I went, and it was a small field.